Thank you.
Oh, Kathy, would you like to lead us in the Pledge of Allegiance?
I will do so, yes. I pledge allegiance to the flag of the United States of America
And to the
and to
republic
the republic
for which
it stands,
one
one
nation,
nation, under God, indivisible,
and justice for
with
all.
liberty and justice for all.
Okay.
Sounds like an echo chamber.
It does.
Well, it sort of was.
So, Catherine, I do have to say, when you asked me to start the pledge, I just have a horrible memory of when I was leading the pledge at one of the Board of Trustees meeting at Mendocino College.
Oh.
And I put my hand over my heart and I started it and I said, I pledge allegiance to the board. And it was awful. Anyway, so I can pledge allegiance to this board too.
There we go.
Oh, we all
I can just see it, Kathy.
Yeah.
Well, thanks for sharing. Now you know it's endearing now.
Yes.
So, has there been any public comment, Judy?
No public comment. We have had one phone call come in, and that phone call we'll deal with after the meeting.
Okay.
That was as of this morning, so a little late for this meeting, but I think we'll deal with it after.
Okay. Well, then I will have the honor of swearing in our new board member, James Anderson. Okay. Welcome, James, and I'm so happy you're here. It's just wonderful. Okay, so James Anderson, do solemnly swear that I will support and defend the Constitution of the United States
that I will support and defend the Constitution of the United States
and the Constitution of the State of California
and the Constitution of the State of California
against all enemies, foreign and domestic, that I will bear true faith and allegiance to the Constitution of the United States and the Constitution of California,
that I will bear true faith and allegiance to the Constitution of the United States and the Constitution of the State of California,
that I will take this oath freely without any mental reservation or purpose of evasion,
that I take this obligation freely without any mental reservation or purpose of evasion,
and that I will faithfully discharge the duties upon which I am about to enter.
And that I will faithfully discharge the duties upon which I am about to enter.
I hereby attest that as a member of the Board of Retirement of the Mendocino County Employees Retirement Association,
I hereby attest that as a member of the Board of Retirement of the Mendocino County Employees Retirement Association,
I will carry out my duties and responsibilities with respect to MSERA, in accordance with the highest fiduciary standards and in compliance with the laws, regulations, and policies applicable to MSERA. Congratulations, James. You are now an official member of our board.
Thank you very much. And I must say, a real pleasure, not only coming back and participating in MSERA, but with such a wonderful group of board members. I think you just got an excellent board, and it's going to be, I think, a pleasure to work with all of you on MSERA's issues.
Okay, so I wanted to discuss some possible options. We could discuss and possible action regarding election of board retirement officers for 2020-21 and appointments to the audit committee. Or I'm not sure, Judy, you were saying that Callan is here already. Do we want to jump forward, or do we want to just follow the regular board agenda item?
Callan had been told we'd be ready for them at 8:45, so you do have a few minutes.
Okay, so we can go forward with the agenda item 2, discussion and possible action regarding election of Board of Retirement Officers for 2021 and appointments to Audit Committee. So are there any, does anybody want to appoint a new board chair for the coming year?
I would like to jump in there. This is Sherry. Dan, he's the vice chair and normally he would move up, and I just wanted to check to make sure that he was okay since he's going to be chair of the Board of Supervisors. I mean, we'd love to have him be this chair as well. Are you okay to do that?
Dan?
Yeah, I could do that. Is there someone else who would like to be chair next year?
Kathy, would you be interested in?
I would love to nominate Kathy as either the chair or the vice chair, but I don't want to go over Dan, but if Kathy would be willing to even be vice chair, I would love to see Kathy in the transition. So
Thank you, Sherry.
you would be perfect, and you would be perfect, and you can step right in. But Dan is typically, we have Dan, we have our vice chair step up, and Dan would be a great chair, but it's up to him, I think, if he wants to do that and have both chairs at one time.
Well, I'd be glad to serve as vice chair with Dan as chair.
Okay, thank you.
So I nominate Dan and Kathy for chair and vice chair.
And then the secretary, and I don't know if anybody else is interested, but I was thinking that Richard would be a good secretary. He's been on the board for a long time. Tim's always been the secretary. I was thinking that, I know Richard's not here, but that was just my thought. I don't know if anybody else has any thoughts.
I think that's a good idea, except
That's a good one.
If Richard chooses not to be the secretary and he's not here, we can't just.
He's not here, so he can't say no.
Yeah.
Okay.
That's a natural consequence.
He should have been here, right? If he didn't want to do it.
Well.
Anyway, that was my thoughts.
Okay. So, do we want to do this with a motion, or do we want to take a vote?
I think Jerry did do a motion.
So is there a second?
I'll second.
Okay.
Now, does that include Richard? It should be the slate.
Okay. Let's include Richard.
Okay.
Not here. Okay. We'll do a roll call vote. So all those in favor. Wait, before we do the roll call vote, let's do, is there a discussion on the motion? Any discussion? Okay, we'll go ahead and do a roll call vote. All those in favor. Judy, can you do a roll call vote for us, please?
Yes. Ms. Shatmeyer?
Yes.
Ms. Forrester?
Yes.
Ms. Cavanis?
Yes.
Mr. Parker?
Yes.
Ms. Smith?
Yes.
Mr. Cromer?
Aye.
Ms. Harris?
Aye.
And Mr. Jurdy?
Yes.
And Mr. Anderson?
Yes.
Thank you.
Okay, motion passes. It's unanimous.
Look at that. Jim gets to vote on his first upset, and Richard said he hardly ever got a vote. That's funny.
Does the chair get to vote if there's, does the chair vote?
I believe so, yes.
In the absence of a tie?
Yes.
Okay.
Okay, so we have our new officers, and let's see, does this take effect right away, or do we wait till the next meeting?
In effect now.
Okay, so Dan, if you would please take over the meeting, I appreciate it.
Okay, thank you, Catherine. And thank you for your service as chair for 2 years. Discussion and possible action regarding adoption of the 2021 board meeting calendar. Has everybody had a chance to review the calendar, and does anyone have any comments on the proposed calendar?
Dan, I do want to point out that last item had the audit committee on it too.
Okay. Okay.
But I'm
so
okay with the calendar.
we do have an audit committee, and I guess I didn't pull up that item. Do the current members of the audit committee wish to continue serving on the audit committee?
I would like to continue serving on the audit committee.
I'm
Who
fine.
else is
Would like
on
to
it?
as well.
Julie, and
I'm
what's
fine unless
Julie
somebody
and
else would
Catherine?
like to.
and Kathy, weren't you getting?
Well, I was kind of interested, but I think Jim would do a good job if he's willing to do that.
I would be willing as long as it's appropriate for an alternate to serve on a committee.
Who's on it and how many people are supposed to be on it?
There are only 3 people on it.
Okay.
Julie,
Wasn't Tim on it?
Tim was on it.
yeah, Julie, Lee, and Catherine, right? Are on
Yeah.
it right now, and Tim
Four
is
of us.
moved off. Yeah.
But Lee was on.
Yeah,
He was on.
Lee and Julie and Catherine were on it. And then Tim was on it, but Tim's gone now, so his position needs to be filled.
So normally 4 members, unless you decide you'd just rather have a 3-member committee.
I think having more is better.
Well,
I would do it if no one else does it.
It's not a deep dive.
Jeff, is there any reason why Jim Anderson would be prevented from serving?
You know, I'm trying to dig back into my brain a little bit. I remember this issue coming up, and I honestly can't remember. I think it's possible that there could be an issue. But I think it's okay. If it's not, I'll get back to you guys next month, and we can switch them out if you'd like Jim to be the 4th.
I would
And
like that.
Jerry just showed interest too.
If Jim, I would prefer Jim, but if he can't do it, and we need a 4th, I'll do it.
I think the real value of serving on the audit committee is to educate members as to, it's more educational for the members than it is functional. I mean, we have auditors and, business is taken care of, and it's you learn a lot being on the audit committee more than you actually do anything.
Okay. Well, I'm hearing that the current members would like to continue serving, and Tim is obviously off the board. But I also heard, I think, that Jerry and Jim would both like to be on it. Given the fact that we don't know for sure if Jim can serve on it, and I think at some point this year there may be another opening. Lee is on the board until replaced, but he can't be reappointed. So there is a likely additional opening with Lee's position at some point. So based on that, let's put Jerry on the committee as
Dan, can I ask you to switch that and put Jim on, and if he can't do it, then I'll do it?
if we could make such a motion, I looked at Jeff for that.
Yeah, I think you can make that motion.
Okay. Well, then if the chair can appoint, I would appoint the current 3 members and Jim Anderson. If he is unable to serve due to the fact that he's an alternate, then Jerry would serve in his place.
Thank you,
Can I ask, is there a meeting scheduled that would happen even before the next board meeting?
For the audit
No.
committee,
No.
Yes, for the audit committee.
we don't meet that often anymore, so no.
I think it'll likely be May. Do you guys usually,
Okay, so
I mean,
We've met one time a year in the last 2 years
in November?
in November. Yep.
November.
Okay. Based on that, Jeff, do you think you'd have the information by our next meeting?
for sure.
Okay. Maybe we could just postpone this action to our next meeting.
Sounds like a good idea.
Okay. But thanks everyone for volunteering to serve on the audit committee. Okay, now on to discussion possible action for the board calendar. Does anyone have any objections to the calendar as it's prepared?
No. I make a motion to accept the calendar for 2021 as is.
Second.
Okay, Judy, can you call the roll?
Yes, I will. Ms. Shatmeyer?
Yes.
Ms. Forrester?
Yes.
Ms. Cavness?
Yes.
Mr. Parker?
Yes.
Ms. Smith?
Aye.
Mr. Cromer?
Yes.
Ms. Harris?
Aye.
Mr. Anderson?
Yes.
And Mr. Jurdy?
Yes. And I think Catherine asked for public comment on non-agenda items, but I just want to make sure that we did that.
Yeah, we did that.
Okay. Okay. Now we're on to discussion and possible action regarding any consent items needing, well, we had none that needed separate consideration. Discussion and possible action regarding extension of the existing lease agreement with the state of California.
Chair Judy, there is a lease extension offered from the state included in your packet. They're asking for a 2-year extension to run through February 28th, 2023. They're asking for no significant changes in the terms of the lease. It includes the cost escalator tied to the CPI as in their current lease. And based on a preliminary review of other lease rates available in the area, it looks like they're paying a market rate.
Well, thank you. I certainly hope that they renew it 2 years from now as well. Many of you probably know that the state of California is looking at reducing the properties that they're leasing with employees increasingly working from home. And, you know, I don't know, did they mention that in their discussions with you?
In the brief call I had with a representative from the state, they said due to uncertainties at this point in time, they only wanted to execute a 2-year extension, but they didn't really go into the rationales under why.
Okay. I think it would be good to stay in contact with them and find out if they might be scaling back at some point, because then we need to look for another tenant. That's why I bring it up.
Are they looking?
Do we have any comments on those lease, or do we have a motion to approve?
Question? Well,
go ahead.
Are they asking us to pay their broker's commission?
I don't think there was anything in the lease regarding a broker's commission. I don't know if there was a broker's commission paid last time they did a modification or extension to their lease. I'm not prepared to answer that question.
Because I've seen the state pull that where they demand that their broker, in basically as somebody's brother-in-law, get paid a commission on renewals of 10-year leases. It's just outrageous.
I had no idea.
The state is The state is known to be about the worst tenant in the state of California.
I don't believe there's such a provision.
Okay.
Any other comments on the lease?
Mr. Chair, I'd move that we approve and adopt the amended and updated lease from item number 6 on the agenda.
Second.
Oh,
Okay, we have a motion and a second. Seeing no other comments, do we have any public comments in this item? Okay, Judy, can you call the roll?
Yes. Ms. Shatmeyer?
Yes.
Ms. Forrester?
Yes.
Ms. Cavanis?
yes.
Mr. Parker?
Yes.
Ms. Smith?
Yes, aye.
Yes, the girl.
Mr. Cromer?
Aye.
Ms. Harris?
Aye.
Mr. Anderson?
Yes.
And Mr. Jurdy?
Yes.
Okay, approved. Thank you.
Okay, thanks. And that takes us to discussion of possible action regarding investment matters, including monthly investment reports for October and November.
Yeah, we do have Callan here. Greg, Claire, welcome.
Okay. Well, yeah, thank you. It's good to see you all. I'm kind of Zoom bombing today. Unfortunately, I have another commitment in a little bit, so I'm going to drop. But Claire is here, and one of our research specialists, Johnny Gould, is on the line. And we had two things we were going to talk to you about today. The first is a quick update on performance through November. And then the second is a purely educational session on real estate. And as you all know, a lot has been going on in real estate. You were just alluding to leasing and what the state of California is thinking about with work from home and impact of COVID going forward. And there are a lot of implications to this across your entire real estate portfolio. So Johnny's one of our real estate experts, and he's going to talk to you about this. And again, this is purely educational, just to give you a sense of what's going on in the real estate market, because it is a portion of your investment program. So quickly talking about performance through November, performance is quite strong. For the month of November, the total fund's up about 10%.
Yay.
And the benchmark is up about 8.7%. So that's the month of November. And on a fiscal year to date, so you're a June 30 fiscal year, fiscal year to date, you're up about 15.2%. And the benchmark is up about 13%. So one of the big things we've seen since, frankly, the election is that the capital markets have rebounded strongly. One interpretation of that is that the capital markets like either gridlock or moderate policy. And that seems to be what Washington has in store for us post-election. So that's one interpretation of that. The other is that we have a sight line to the end of the pandemic now. It's still months away, but we have a sight line to it. And with that sight line, you've seen a huge rotation to stocks doing well that are post-COVID stocks. So to date, we've seen all these stocks run up that are these stay-at-home stocks. Peloton, for example. The market is now starting to look forward and say, well, what about these other companies that are going to do well in a post-COVID world? So you've seen a huge rebound in things like airlines, right? Things like hotels. So the market is starting to look forward. Now, I bring that up because that's meaningful for you, because a lot of your active managers were a little overweight that sort of exposure. They had lagged a little bit for part of the year-to-date time period, but in November, they came roaring back. So that explains a lot as to why you're outperforming the target so much in the month of November. And so that's really good to see. You might recall that we did a structure study for the equity portfolio a while ago, and we decided to take out the large cap active equity and move to the S&P 500 index fund. But what we did decide to do is that over a 5 to 6 month time period, we're going to leg into that position. And that's proved to work out pretty well because we didn't want to just turn on a dime and do it. And legging into it has worked out well because some of those managers have come back and we've benefited from that. So real strong absolute returns in November and pretty strong relative returns in November and on a fiscal year to date as well.
Nice.
And it's kind of crazy. I was thinking about this morning. It's been one hell of a year, right? In so many levels, and on a fiscal year to date, we're up 15%. It's kind of crazy. It's just going back to the fact that the stock market is not the economy. And while we all might feel vulnerable from a personal financial situation, the stock market is not the economy. So real strong returns, and total assets are at about 616 million. Just going off of memory, that might be a high watermark from an asset perspective.
Nice.
So that's the month of November. And now we're going to switch over and talk to you about just the educational session about real estate. And with that, I don't know who should share their screen for the presentation.
I can go ahead and do it.
Okay. There we go.
Can you see it?
Yes.
Yes.
Yep. Thank you, Claire. Okay, so Johnny's going to walk through this, but on the first page here, I'll just level set and remind you what sort of real estate exposure you have. So you have about $60 million currently allocated in aggregate to two core open-ended real estate funds, one by Lease and the other by Barings. So that's what you currently have exposure to, two core open-ended real estate funds. When we did our last asset allocation work, we decided to add a new diversifying real asset, and that's infrastructure. So over the long run, we're going to have a 6% allocation to infrastructure. And what this chart shows is what you are going to be exposed to in the long run. It's not where you're at today because you don't have any exposure to the infrastructure yet because they haven't called capital for that yet. But in the long run, you'll have another $30 million approximately based on today's market values in infrastructure. So that's what you're currently exposed to. And the one line item we don't have in here is the King's Court asset, so your building. And that's currently valued at about $1.3 million. So we didn't include that in this analysis, but you also have that in the real estate portfolio. So that's what you currently have. And now Johnny is going to walk through and give you a sense of what's been going on in real estate in general, and with a particular focus on the core open-ended real estate funds.
All right. Thanks, Greg. My name is Johnny Gould. I'm in Callan's Real Assets Consulting Group, so cover a lot of the real asset space and with a particular focus in the real estate world. So today I thought I would cover kind of what's going on in real estate, as it's, I think, probably the most impacted asset class out there, just in terms of, the kind of impacts of the pandemic. So I thought I'd start out by making just a couple points and outlining kind of what we've seen the impact's been so far to date, and then talk about how it's affecting, how those impacts are affecting investors and clients such as yourself. So really, there's been two main kind of obvious impacts to date. The first one is obviously the impact to the ability or rent collections, essentially tenants' ability to collect rents from their tenants. And so you can see in this chart here, initially at the onset of the pandemic, there was a severe drop off in rent collection, and this impacted really all property types. But you can see from that blue bar or that blue line that retail was significantly impacted. So it affected all property types, but really retail heavily affected. You saw a lot of stores shut down, a lot of business activity slowed, and so it really impacted retail, which was a sector that was already struggling pre-pandemic. You saw a lot of e-commerce take effect over a long period of time, and that the pandemic really just accelerated this trend. Kind of going into it. But as you can see, other property types were affected as well. So you saw a drop off in the office sector, in the multifamily sector, and then the industrial sector as well, though to much lesser degrees, and those have since moderated. The recovery in retail has been very dramatic, but you can still see it's very, it's still lagging behind the other property types quite a bit. And these have kind of held up all right. Again, it varies by property type. Retail, you've seen over the summer, a lot of stores were able to reopen. This includes a lot of restaurants and nail salons and stuff like that were able to kind of readjust their businesses to kind of open to a certain degree, which helped the kind of fundamentals there as well. In terms of some of the other property types, you saw stuff like multifamily, where there was a lot of government support for people to continue to be able to pay their rents. And then again, in an office where you see a lot of tenants that have really strong balance sheets that are continuing to be profitable, they're still able to pay their rents. So while they're impacted, they're still able to pay their rents typically from month to month. So that's where you see a lot of the divergence across some of these property types. And then Claire, if you flip to the next slide, the second major impact that occurred obviously was the severe drop off in transaction activity. So what we saw, if you look at the far right side of this chart, you can see kind of the quarter-to-quarter transactions that occurred, both in volume and number of transactions, and there was a severe drop-off when the pandemic took hold. And so you can see that second quarter dropped all the way down quite a bit from where transactions were occurring in previous quarters, and even there, that was capturing a lot of transactions that were in place that started in the first quarter or maybe at the end of 2019. So really a severe drop off in transaction activity. And this has an important impact for a few reasons. Namely, the one that's self-evident is that it's a lack of liquidity in the market. So in an asset class that's already very illiquid, you see a significant drop off in liquidity, or further drop off in liquidity. And so that really makes it hard to transact. Really, the only things that were transacting were industrial properties, which have performed really well. Again, industrial meaning warehouses and logistics that are really kind of capturing that e-commerce growth. And then anything that's typically pre-let, meaning an office building that already has a tenant in place that's going to be paying rent from day one. So those are really the only ones that are transacting, meaning developments. And then the other impact that it has, obviously, is that when nothing's transacting in the market, it makes valuations very difficult to determine. So if you're an owner of real estate and maybe you're not selling, but you want to know what your office building is worth or what your industrial building is worth, if nothing's transacting in the market, it's hard to have comparable sales and really kind of gauge what your own real estate is worth. So the valuations become pretty tricky in that sense. So you can see it's picked up a little bit in the third quarter, and we're starting to see a little more kind of traction in that area. It still remains very kind of much lower relative to where we were leading into in the quarters leading into the pandemic. So if we flip ahead to slide 4, but what's interesting when we think of these two kind of main effects on the market in terms of the fundamentals, We can see that the flow through to returns and what institutional investors are really experiencing has been fairly muted considering what's been going on kind of at the property level and at the operational level. So you can see kind of across here that income returns have actually held up pretty well. So we're still seeing positive income returns across most property types, even in retail. The one where it's fell off a little bit is hotel, but that's a very, very small component of what we consider the institutional real estate space. And then the valuations have been impacted, but not nearly to the degree that you would think. And so you've seen a couple of slight drop-offs both in apartments and in office. And then again, as I mentioned, retail having further challenges. But even in cases like industrial, you still see positive valuation growth. And when you kind of net that out, you see kind of a modest decline in valuation. So despite the challenges at the property level, the return impacts have been kind of minimally felt so far. We can see that further on the next slide. Claire, if you go to page 5. This looks at more the total return. So instead of breaking it up by income and appreciation, we look at more the total returns. And on the far left side here, we can see kind of what they've been year to date and then over the 1 year, and really seeing kind of that dispersion of different property types. So really, again, reemphasizing the point, industrial has been a very strong performer as more and more people have to stay home, order things online, and really that kind of e-commerce penetration has really accelerated. And that's obviously been to the detriment of retail, which has severely struggled on a year-to-date basis in the last year. But again, that was a trend that was already occurring. The pandemic really just accelerated that, which I think we've all kind of experienced in our everyday lives, how that's worked. And then you can kind of compare it over to some of the longer-term trends to where some of these property types have been performing over the long run. But you can see over the short term, we've really seen that divergence. And then if we go to page 6, Claire, here just want to kind of revisit some of the fundamentals to really kind of get a more granular look at what's going on at the kind of property level. As you can see, some of the longer term trends in vacancy, coming out of the global financial crisis, you saw a steady decline as a lot of the property types recovered, the economy was going strong. And so a lot of the fundamentals remained pretty healthy. And then if you look at the far right side of those charts, you can see in terms of vacancy, stuff starting to tick up, meaning tenants are leaving their space, especially if you think of the office sector where, a lot of tenants are no longer going into the office, a lot of people working from home. So in certain cases, these tend to be long dated leases. So it's hard to give up space kind of overnight. This stuff takes a while to flush out. But in some cases, you see, tenants vacating their leases and coming to agreements with their landlords to kind of vacate that space. You see that in office. You see that in apartments. Those are typically 1-year leases, so those roll over pretty quickly. And so that can actually be captured a little bit more quicker. And then obviously retail, again, with the vacancies upticking there as stores, as challenged retailers struggle to stay open as well. And again, industrial is the opposite of a lot of those retail headwinds, and they've continued to have that steady decline in vacancy, meaning more and more space is taken up. And then the bottom chart is what we call net operating growth, meaning just the amount of income that can be generated from a property. And so when this is positive, that means the demand for space is outpacing the supply of space, meaning there are more tenants in the market wanting space than there is space available, which means you're able to increase the rents, and it drives the income of the property higher because you're charging higher and higher rents. So when that's the case, this is positive, and you can see, and this is measuring growth. So when these start to turn downward, it means that there's less and less demand for space, and then the rents start to drop, or there's more space available. So the kind of your rental charging power tends to drop as well. You can see a very dramatic decline in retail. Again, I've mentioned that. That's a pretty significant drop off to give you kind of a sense of what the challenges are in that space. But in other sectors as well, you've seen a slowing in growth and kind of trending more towards zero. And so that's something that we'll continue to monitor over time. So again, just a closer look at the fundamentals there. In terms of other areas in the market, I mentioned development earlier. Really, with the pandemic, everything's kind of stopped, come to a complete halt in terms of construction. Again, a lot of this is driven by fundamentals. No one's going to build new buildings if there are no tenants to occupy that space. So really the only thing we saw was construction that was already underway pre-pandemic continuing, so kind of completing those projects. Or again, as I mentioned, anything that is 100% fully pre-let where the tenant's already in place before you begin construction. So that's typically what we've seen in that space. So keeping this kind of high level, but if there's anything particular, feel free to ask questions. I should have mentioned that at the beginning. And then Claire, if you head to page 7, I'll wrap up by kind of just putting this a little bit into context, what these challenges in the real estate markets are having, kind of the impacts that they're having in terms of investors and different clients that we've worked with. There's really kind of 3 main points. First off, there's some kind of total plan allocation challenges that a lot of investors are facing. And what this means is what we call the denominator effect. So as I mentioned, while there's challenges in real estate at the kind of property operational level, it hasn't quite flowed through yet to valuations. And so it takes a while for real estate valuations to really flow through. So they tend to remain steady. However, you have a lot of diversified investors who have real estate remaining steady, but the rest of their portfolio has been quite volatile this year. So while, as Greg mentioned earlier, the equities have performed very well in the kind of latter half of this year, they were down quite a bit when the pandemic first hit. So if you look at the end of the quarter, the end of the first quarter, when equities were down quite a bit, and real estate remained steady, you saw a lot of plans that in percentage terms were very over allocated to real estate. And then that's since recovered, and with this surge in equity markets now, they're underweight. So there's a lot of challenges in terms of investors making allocation decisions to real estate. Should they allocate more now that they're underweight, or are they expecting more volatility going forward? And if they're going to drop again, so really challenging to kind of make those decisions in this short term as you kind of have that kind of whipsaw effect with the volatility. And the other thing, as I mentioned, there's a lot of uncertainty looking forward in terms of the different property types, right? So we've seen obviously a surge in industrial and then continued headwinds in retail that have really been accelerated. So really uncertainty kind of on how those property types are going to look going forward. If we look at office buildings, to what extent are we all going to return to offices? How will that look? What will the overall demand for space be? There's a lot of kind of outstanding questions that are kind of yet to be determined. There are a lot of different thoughts on ways they could go, but I think no one has a kind of crystal ball. So again, a lot of sector exposure question marks, and then geographic exposures as well, right? A lot of times, over the last 10 years, we've seen a strong urbanization trend. A lot of young people move into cities with jobs, renting apartments, taking public transport to their offices. That's all been kind of thrown out the window now. So are we going to see a stronger demand for more secondary, tertiary markets that have a little bit more affordable living, better work-life balances? Are we going to see more suburban office where folks will be driving to work instead of taking public transportation? So a lot of those questions, continue to be hashed out. And then lastly, even for investors who are trying to do things, there are a lot of liquidity restraints, as I mentioned, given that the transaction market has really dried up. And then when we look at different funds, typically, as Greg mentioned, the way that most investors in the institutional space access real estate is through the open-end fund universe, the Odyssey. And you can see here where it can be difficult to kind of reallocate a lot of these proceeds as you have these contribution and redemption queues, meaning kind of capital that's waiting to be invested or capital that's waiting to be redeemed back to investors. You can see over the last few quarters, the redemption queues have kind of ticked up as investors have tried to pull money out of real estate. That could be either driven by those total plan considerations, or they're worried about different headwinds in the real estate environment. So a lot of different things like that. So again, a lot of kind of liquidity and portfolio implementation and portfolio management constraints that investors are facing as well. So I guess I'll stop there. I've covered a lot from a high level. I don't know if anyone has specific questions on any of the things I mentioned, or if anybody wanted me to cover anything else. But I thought I would just give you kind of a high-level overview of what we're seeing in terms of the market and what we're seeing in terms of what clients are facing. So I guess I'll leave it up to there.
This is Richard Shoemaker. Can I be heard?
I'm sorry, I couldn't quite hear that.
Richard Shoemaker. Just a question, and this may be somewhat in the weeds around real estate, but do you guys go to a level of examining, excuse me, office project owners and their philosophy about converting to housing in weak housing market, or excuse me, strong needs for housing areas?
We don't dig into quite that level. A lot of times, we're with how our clients typically invest. It's through managers, and they typically have the discretion to kind of make those decisions. And really, they're tending to be following what the fundamentals are telling them. So if there's an oversupply of office, and there's an undersupply of housing, they would certainly make that call to kind of convert that property into more housing and more multifamily. So we don't necessarily have very good data in terms of seeing how that flows through. But typically these are kind of zoning decisions that are happening at the kind of regulatory level and local government level, rather than at the kind of investment level by managers, if that makes sense.
Sure. But how about checking with our managers if that's even on their radar, or possibly some kind of survey throughout the system?
Yeah,
that's an emerging thing in a couple cities.
Yeah, I think the converting part is a challenging one, because there are existing zoning laws in place in certain areas that are zoned for certain uses, being for office or for multifamily or for housing. So converting that is kind of a long process. A lot of the managers take proactive steps to develop new housing. So getting that permitting in place, whether it's through taking land and creating that or anything like that. But converting is a challenging process because it's already zoned in a certain way. So it could take 2, 3, 4+ years to really kind of work through the regulatory hurdles and the local government hurdles to kind of change that zoning. We've seen that also in the space where a lot of managers have tried to convert malls, like old vacant malls, into industrial buildings because it's a better use, but it can take 3, 4, 5+ years just to kind of get that in place before they can even start the project of converting that. So it's something that we've discussed with a lot of managers, but it tends to happen a little bit more at the margins rather than the kind of overall kind of core of what these managers are doing.
Thank you.
I would like to comment also, Richard, just with regard to that. Our managers in specific are fairly well diversified within the 4 property types: apartment, industrial, office, retail. They were never particularly overweight in the retail market, our managers in specific. And I think that's one of the reasons why you can see their returns. Yeah, they've been negative, but they haven't been that negative. They haven't been positive, but they haven't tanked quite as much as they could have.
Yeah.
And I think that's a testament to their diversification, both of the funds.
I voiced strong concern at the time we went into this that I didn't want to see any retail in our portfolio. In my business, we had like less than 2% of our mortgage portfolio in retail, for good reason. And I don't, we're not supposed to put our hand on the wheel as far as investments go, but I got to say, I don't want to see any of our investments in retail real estate. It's a loser. There's only so many thrift stores that are going to fill all this vacant space. As you drive across this country, every little town, the cute little downtown now is nothing but antique stores and thrift stores. And, until these cities wake up and change the zoning and make it easy to convert superfluous property, including office and retail, to residential, which is there's a real need for, this is going to continue. Another point that I have a big concern about owning real estate is we're at historically low interest rates. And interest rates are what drive the value of property. So when interest rates go down, properties go up in value. When the same property, when interest rates go back up, the values decline sharply. When you go from 2% interest rates to 6% interest rates, you just crush the value of properties. And so seeing real estate as a long-term hold frightens me. We've heard that interest rates are going to stay low for quite some time. Well, that's great, but I don't want to be at the party when they start to turn. That's my opinion.
I have two questions as well, if I can.
Go ahead.
The first one, what has been the impact on the real estate side of the moratorium that was placed statewide on the evictions in California, if you know?
I'm sorry, I couldn't quite hear that. Let me try to turn my volume up here.
What's the impact real estate-wise on the statewide moratorium on evictions in California? Has that had a significant impact on our portfolio?
It hasn't had a significant impact. Again, these portfolios are very well diversified by property type and by geography. So if you're alluding to specifically to the California ones, but then again, California is a big market and it has a significant presence in the overall market and in these portfolios. And so the eviction moratorium certainly assisted in terms of keeping tenants in place. And then they were also supported in terms of allowing them to continue to pay their rents. Now that's increasingly becoming more and more in question as we kind of move towards additional, potential stimulus and those different things. But in terms of how it's done so far, it's I think supported. If you look at the total picture, it's supported the portfolios today.
Very good. And the second question, with us awaiting on them to pull our capital for the infrastructure investments that we've approved for the diversification, how concerned should we be with that strategy that we're moving forward?
With infrastructure?
Yes.
Again, with infrastructure, there's a lot of internal diversification. So it's an asset class in and of itself, but there's a lot of subsectors within infrastructure. There's a couple areas where there's going to be some concern. The one that really jumps out are airports. Those are ones that are going to be challenged. Obviously, not a lot of people are flying these days, and a lot of the way that a lot of these managers and funds will earn profits and income on airports is it's known as a dual till system. So they'll run the airport operations, and those will be generally run kind of neutral or a slight profit. It's highly regulated. But then the other till is the retail side, meaning anytime you buy a beer in an airport or shop or anything like that, that's a retail component. So that's obviously been severely affected, and they're expecting that to not to recover until probably 2023, 2024. So that's an area that's challenged. But again, in infrastructure, it's very well diversified. So there's lots of energy related assets. There's lots of utilities. There's lots of other, transport. There's ports. A lot of different things that have continued to perform well. And these are regulated, long contracted revenue type assets and businesses. And so the idea is to be very low volatile, very steady returns, and very cash flow generative. So I don't think there's a significant concern. You do want to monitor those kind of sub pockets of exposures that could be challenged, kind of as we're in this pandemic, and kind of see how those continue to behave over time. But again, due to the internal diversification, you're not overly exposed to any one thing that's going to be severely affected. And they've performed well through the pandemic. I think they both had both of the funds that you're going into are in the kind of mid 3% year-to-date return through the third quarter. So they've held up pretty well. But again, there's still pockets you want to monitor in terms of the risks there. Was that helpful?
Very much so. Thank you, Donnie.
Okay.
Donnie, can you tell us how much retail real estate we're invested in or would be?
To the dollar, I can tell you in terms of percentage terms, I think it's in the 15 to 18% range if you look at both funds, and those
are. How do we get out of it?
Sorry.
How do we get out of it?
Well, you'd have to get out of the funds entirely. So the funds are diversified. There's a universe of these open-end diversified core funds. They all, unfortunately, have exposure to retail. There's a couple of paths you can do to get out of those funds and go into other funds that are sector specific. So you can do kind of an industrial only fund. You can do an office only fund. That becomes a little bit more of a portfolio management challenge, as these sector specific funds are less conducive to getting in and out of, and they're a little bit more volatile, a little bit more core plus, higher risk, different things like that. So you'd have to kind of entirely pull out of these funds if you wanted to completely eliminate your retail exposure. But the good news is,
go ahead.
Sorry, the good news is that they're equal or underweight to look into retail. I'm sorry?
I say, does anybody else on the board want to look into that? Retail is just a crush. I don't want to be there.
Yeah, and what I can at least tell you is that for these funds, that the predominance of the retail is at least in more necessity-based shopping. So think shopping centers with grocery anchored. I know it's still not ideal, but it's a better type of retail than these super regional malls and power centers that have really been impacted. And especially the ones that, so these regional malls that were struggling to begin with, and then they put a lot of capital into kind of converting their malls, having them be more kind of experiential shopping, which we call it, which included restaurants, bars, gyms, those types of things. And those, of course, have been impacted as well. So there's less exposure to those on a relative basis, and more exposure to more kind of grocery anchored, what is called necessity-based shopping, drugstores and things like that people still need to go to, and can't just do all their shopping online. And so there's a little bit of benefit at the margin there, if that's helpful.
Lee, I can get back to you. Like I kind of mentioned before when I was commenting on Richard's comment, the two real estate managers that we have, they are diversified and they are not primarily in the retail space. Off the top of my head, and I'm trying to get into the shared drive here to look, but I can get back to you and basically let you know, my guess would be that with both of those funds, the retail is less than 25% of each fund. So I would guess
it here. They're both exactly at 18%. So,
so that if that gives you any bit of if that makes you feel any better, they are not 100%. They're not even 1/5% of their fund into this retail space, which has definitely seen some challenges.
So this is.
Go ahead, Richard. I'm sorry.
So I guess what I would join in with Lee on this look and concern, and perhaps Robert could do some more digging, and we could get a deeper level look at what these retail ownerships are in our funds. And the issue I brought up, I think, is in California, in the large cities, is going to be a pretty significant issue. And I realize that all the zoning issues are there, but it will be a trend as people do not go back to office work and they move out to the country, to Ukiah, to Fort Bragg, and work from there. So and to me, it's a long-term thing. So if put Robert on a little journey here to dive a little deeper, and if it's something the entire board wants to look at after he comes back, I would support Lee's issues in that and utilizing our staff in that way.
I have a question.
Catherine?
You say 18% of our real estate holdings may be retail. How much of our total portfolio are our real estate holdings?
Right now, that's at 10% as of last month.
Okay. And we're headed up to a higher percentage there? Correct.
As the international equities and domestic equities have gained value, you could actually see that the allocation went down just a tick. So, as long as we don't get down to our lower limit of 6%, we're going to let that ride.
Okay.
Yeah, so the target real estate is not changing,
The 10%.
the target.
Okay.
And that's
So
real estate.
10% times 18%, whatever that is our percent of retail in our total portfolio.
Right.
Yeah, so the target is 11%, and what is being added is the new infrastructure allocation.
So it's about $6 million.
Okay.
You take 10% of 600 is 60, 10%, 1% of that is 6. I think it's
1.8.
2%. Yeah.
Yeah, I can definitely go back and look in detail and bring that information back to the board, either in an email format or at the next meeting.
And what I think may also make sense is the goal of today's discussion was a broader educational market discussion of real estate. And then we can have a deeper dive discussion at a subsequent quarter meeting about your portfolio in particular, especially as the infrastructure allocations are funded and that capital gets called.
I mean, if we can buy funds that don't have retail in them, why don't we do it? What's so hard about that? Why are we married to buying retail just because it's in a basket called real estate? It makes no sense to me. It's a dead horse as a category. Sure, there are leases to Safeway that are going to be good, but as a category, they're a loser.
So it sounds like there's interest in finding out more details about our real estate holdings, and I did hear in this verbal presentation that as a percentage of our retail, a fairly high percentage is for essential services such as supermarkets and drugstores. But if you could dive a little deeper into that and give us more information about that, I think that'd be helpful also.
Sure.
And maybe work with Robert to give us a written report, and we could discuss that at our next meeting. Thanks. Is there anything else you wanted to present on real estate?
That was it. Again.
I had one question, Dan.
Oh, go ahead, Jerry.
John, you used the term, excuse me, odyssey, or I thought you did. Could you explain that to me?
Yeah, apologies. I didn't. That's a little acronym. Odyssey is just a way. It's not the word Odyssey. It's a way to say ODCE. The letters ODCE. That stands for open end, diversified, core equity.
Got it.
It's just a term for the benchmark, or the benchmark is just a peer universe, a group of funds that are all these core open end diversified real estate funds. Fortunately, I think they pretty much all have retail. Again, the weightings vary quite a bit, but sorry, that's just a real estate acronym that we use, and we call it the Odyssey to kind of.
Okay, it makes sense now. It went right over my head. So.
Yeah, my apologies. I should have caught myself there.
One more question.
Go ahead.
Okay, I'm back to Lee's numbers, because if we've got 600,000 in our total investment. I'm sorry. What?
I believe it's 6 million.
6 million.
60 million. 60.
And that is okay. I'm trying to figure out.
Category, 10% of that would be 6 million in retail. So.
But we are 18% in retail out of our 10% of real estate. So okay.
2%, almost 2%.
Okay.
Like
so it might be more than that.
It'd
anyway,
be like 10 million.
Yes. I appreciate it.
Okay, right. Sounds like we're wrapping up, but is there anything else that either Doris or Robert would like to add?
Regarding this topic, thank you, Johnny. We appreciate that.
Yep. No problem.
Thank you very much.
Thanks, everyone.
Nice to see you all. And again, we'll hope to do a focus in on your portfolio specifically at a future meeting.
Great.
Thanks, Claire.
Thank you.
Happy holidays. Nice to see you all.
Take care. Happy holidays.
Happy holidays.
So just to recap, did we cover everything we wanted to cover under domestic equity next steps?
Yeah, well, I guess I'll give you just a quick update, which you can see on the November investment report. We're just continuing that transition. This month will be our third month of that. And it's looking like we may be able to finish the transition in January, depending on exactly what happens over the next month here. But so really just wanted to give that update and let you know that we're almost finished with that transition.
Okay, thank you. All right. Well, then it looks like we're on to agenda item 8, which is audit committee report and recommendations.
Actually, Dan, if I may, I was able to confirm that Jim can serve independent of the non-alternate trustee, and he can serve on the audit committee. So if you want to go back and make that motion for the committee, you can do that now.
Okay. Clarification, as the chair, can I appoint or do we make a motion?
I think actually you're right. You can appoint it as the chair.
Okay. So as chair, I'll go back to item number 2 on the agenda, which is appointments to the audit committee, and reappoint the sitting members and add Jim Anderson to the audit committee.
Good.
Okay. Now we're on to number 8, which is the audit committee report.
Thank you, Chair Jurdy. The independent auditor's report is provided in your packets today. The audit committee has already reviewed this information. Included with that are our financial statements. And if you have any questions regarding the audit report or recommendations, I'm happy to take any questions.
Not seeing any questions. Do we have any questions or comments from the audit committee members? Okay, not seeing. Judy, do we have any public comments on this item?
No, we do not.
Okay. Okay. Well, would someone like to entertain a motion to adopt the recommendations? The
I make a
independent.
motion to adopt the audit findings.
The audit committee has made a recommendation to adopt, which would become the first motion and the second.
Second.
Okay, so we've got a second from Richard. Will you conduct the roll, Judy? Thanks.
Ms. Schattmeyer?
Yes.
Ms. Forrester?
Yes.
Ms. Cavanis?
Yes.
Mr. Parker?
Yes.
Ms. Smith? You're muted.
You're muted.
Oh, I'm trying.
There you go.
Sorry.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Drum roll, please. Yes.
Whoa.
Ms. Harris?
Aye.
And Mr. Jurdy?
Yes. Although Richard, actually, we got to let you know that Jim actually voted before you voted.
I know, but so that makes mine the first for me.
Yeah, historical meeting here.
Yes.
Okay. All right. Now we're on to discussion regarding the administrative reports.
Thank you, Chair Jurdy. This month, we sent out the first round of correction notices. 22 notices were sent. There's a brief summary in your packet regarding that correction project. Also, I just wanted to comment that we have essentially a full slate of board members with the Board of Supervisor appointments of yourself, Chair Jurdy, Geraldine Harris, and Catherine Smith for terms through 2022 and 2023, depending on the seat. Our holiday office hours, we will be closed to the public during the week of Christmas, and then we will be closing at noon on the 31st before the New Year's holiday. It is time to renew our fiduciary insurance, and there is the waiver of recourse payments premium, which is split among the trustees, and we are requesting that each trustee pay $9 via check made out to M. Sarah by the January board meeting for payment of the waiver of recourse premium. And as a reminder, as this year wraps up, your Form 700s will be due to M. Sarah at the beginning of the year. I believe the deadline is not later than April 1st, and those should be turned in to Judy. We have a legislative update attached, and I also just wanted to mention we did receive a letter regarding the correction project from the SEIU Local 1021, which was distributed to the board. I'm working with council regarding a staff report that will be on the January agenda for discussion.
And I will add that I will be forwarding the 2021 Form 700s by email after the first of the year once they become available.
Okay, thank you, Judy and Doris. Any comments on any of these reports?
I had a couple of questions. On the spreadsheet that was attached for the corrections, I was wondering if you can explain the method that you're using to work through those errors and which ones have been impacted so far, you know, which type of action or error, if there's a way that you can list that on that spreadsheet instead of grouping it together and saying 12 underpaid, 10 overpaid, if there's a way to itemize those without naming.
Yeah, I could work on a chart that would break it out by the type of errors on a specific correction and the net impact to the employee, or rather the retiree, with no identifying information, so you can see what errors were wrapped up in this one. This set of 22 is a combination of some that had just been worked on. There wasn't any priority of any particular errors to focus on. Then a few months back, we are focusing on errors 1, 2, and 12 because those had the longest correction period for the retiree as far as retro payments due. And we were trying to get those done as a priority so we could get those retro payments issued. But this is a mixture just because some of them had already been done and they were easy enough to update to get notices out in this first round, and we continue to work on the project.
So going forward, how are you, so you have the first corrections that are the oldest correction date, how are you going forward addressing?
It's going to be a combination. You know, they had roughly 100 or so corrections calculated, but many of them were out of date and need to be updated. So as time permits, we'll go back and grab some of those corrections that were calculated but just need to be updated and include those with groups going out. As far as new calculations, the focus so far has been on those initial 3 errors that I just mentioned, and we're establishing what the priority would be as far as which errors going forward, but we do have a number of ones that initially had been recalculated that we're just trying to get updated and also out with some new corrections.
Okay, and so did all the notices get mailed that stated they were affected or not affected?
Yes, those went out after the November 4th meeting. So all retirees received either the notice telling them that they were not impacted or that they were impacted. We sent, I believe, 490 notices to employees, or retirees, to let them know that they were impacted and would be subject to recalculation. That count of 490 does not include the Alameda corrections that had already been processed before November. We had wrapped up all of the Alameda corrections prior to that date. So everyone got their general notice of the project, whether they were impacted or not impacted. This notices that went out in December, the first 22, those are actually the individual specific notices to members outlining what their correction was.
Okay. So going forward, will you be able to say the method that you're going to work through the corrections? So a retiree could look at the individual items and then say, okay, they're going through, say, number 7, and so I'll have an idea soon that I'm going to get my specific impact to me.
I can try to put together something like that, again, because some calculations contain more than one error. It's not as simple as saying we're going to necessarily address all of issue number 7 simply because of the complexity that are involved in some of those recalculations. To that end, we are looking at ways to prioritize where possible what of the errors should be focused on first, and I can provide a list to the board in the next month's report as far as not just more detail on which errors were being worked on in that month's correction notices, but also the priority of other ones moving forward. Sure.
That'd be great. Thank you.
Richard?
So for anybody watching and for board members, could you explain each column in your summary report in detail?
Certainly. So we sent out 22 notices in December. The change would be effective with the January 2021 benefit allowance payment. The total amount of increase in benefit payments relating to the corrections is the amount listed as total new benefits of $31,945 and change, compared to their old benefit amount. So that's what these 22 people will continue to receive on an ongoing monthly basis, is the $31,945. Their prior amounts totaled $31,526. The net change in monthly payroll related to these 22 corrections is $418. So that is obviously a combination of some people's benefits going up and some people's benefits going down. I can, in next month's report, where I break it out not only by the type of error that was being corrected for a particular record, give you more specifics regarding the change in the monthly benefit associated with that, if the board would like that level of detail.
Yes.
So with this, there was total retroactive benefit allowance payments totaling $175,900 that's going to be issued in January. This is probably a slightly larger amount in some regards because, again, part of the focus with these first few rounds are those 3 corrections that I had mentioned previously that have the longer historical correction period going back to 3 years before the PEPRA changes and some other changes that were implemented in January 1, 2013. So these errors do have a longer look back period that we're correcting for. And as far as overpaid benefits that we are not seeking to collect from a member, but they are reflected in our UAAL for employer contributions, also totaled $175,800 and change.
Doris, it sounds like you're saying that these 22 may be more significant than the average within the 490 retirees.
I would not say that necessarily. I would say, because we haven't finished those 3 errors that have the longer correction period, but that the total amount of retro payments in these first couple of months will likely represent a higher amount than later in the project when we're dealing with shorter correction period for retroactive payments. Mr. Anderson?
Yes, thank you. And Doris, I've received a number of phone calls from retirees, and I'm thankful that all of them have communicated that they've either spoken to you directly or to staff members as well. So I'm glad that they're turning that direction. But and I know this has been a long process, a well thought out process, within the parameters of what the board has decided to do as far as how to roll out this correction process. Within that, any amount of information that you can provide that gives retirees a better understanding of how this issue is being resolved and addressed, I think would be helpful. There's a lot of distress out there amongst what's going to happen to individual retirees.
And I do understand that. Part of the effect of sending out the general notice that said you're one of the 490 who are affected and we will be recalculating your benefit is that at the time that notice went out, we don't have the specifics available to tell that specific individual whether they were overpaid or underpaid and the amount, or when, what month exactly we'll get to their calculation. So that notice has created a lot of uncertainty and anxiety among the retirees. I think part of that was known and we expected it, but the board felt very strongly that they wanted to try to get this information out to our membership in order to be transparent regarding the project. Each retiree will receive a specific correction notice once their calculation is done that identifies the specific item or items that affected them and the impact to their benefit. Unfortunately, I can't give them that information before the calculation is done, and it's going to take us months to work through these. Yes, Richard.
I would second that. I've received phone calls, as Jim has, and working to direct people back to you for details and giving a sympathetic ear. So in the report, a question I have, there is the total retro payments and the total in UAAL. Are those, can you combine those to see the gross impact to the system, or are those basically the full impact of the system? Do you understand what I'm saying?
I do understand what you're saying. And as far as those two numbers, the total retro payments issued relates to payments being issued to the 12 people who were underpaid. The total in the UAAL is representative of the total amounts overpaid to those 10 individuals over their entire span of retirement. While the 175,846 is already a part of our UAAL and in our employer contribution rates already, one could conceptually say that the combined effect of the plan is the combination of the retro payments and the UAAL amount for a total cost of a little over $300,000 in that month.
Thank you. That was what I was looking for as a confirmation.
But that's not a new amount being added to the AAL. It's just what I want to stress. Those amounts have been incorporated in our UAL every year as those retirees have been paid. So there won't be any additional amount added to the UAL as a result of those underpayment or overpayments that were identified. Thank you.
I will also recite to the board for folks that are concerned that they won't be paid for their underpayments over a long period of time, that maybe you could reiterate the issue we have around beyond the statute of limitations.
The California Code of Civil Procedure does reference a 3-year statute of limitation as far as sort of a look back period. That look back period is being applied to what we refer to as a corrective action date. The corrective action date for the majority of errors identified in the voluntary correction plan is going to be June 1st of 2020 as of the date that we filed, due to a couple of errors that were known a couple of years ago, back in 2016 and back in 2013, but are not being corrected until now. those look back periods will go from that corrective action date back 3 years. Some of these retro payments here are reflecting payments from January 1st, 2020, because that retroactive look back period of 3 years applied before the corrective action date, and then we're bringing that forward up into the point that we issue their correction. So it's not just a 3-year payment. Even for someone who we're using a corrective action date in 2020, it's not 3 years. It's 3 years plus the time from June 1st, right after we filed, to the date we get their correction in the payroll system, so they would receive more than 3 years worth of retroactive payments in that regard.
All right, so that would confirm to those people that if they had an correction being made for a period of, say, 10 years, they are sacrificing a portion of their unpaid benefits under the correction program.
There will be instances, yes, where someone will have been retired longer than the period of retroactive payments that were authorized by the board with the filing of the VCP.
So this is been asked to be a message to this board that some people are suffering at a higher level because of this program. Thank you.
Okay. Do we have any other questions, or do we want to go on to board member reports?
Just a correction. Let's take a look at that heading and be sure that we don't have any spelling errors in there. Historical Benefit Review Project.
That will be my next month report.
Thanks.
Right?
Thank you.
Okay.
Can I ask one question?
Go ahead.
Yeah, this is Sherry. So I'm just curious because and I get what Richard's saying. I absolutely get what he's saying. And I feel for everybody that's affected by this. But our legal counsel advised that we do this. And we had a pretty extensive legal counsel. Is part of that, and maybe this is for Jeff and also, for Doris, did they do that because they feel that that's our best chance of the IRS not throwing out what we're doing? I'm just curious because that's the one thing that I grasped from the direction that we got from our legal staff was that.
So Sherry, I'm going to interrupt for a moment. So I think, there's a little bit of a tension here in terms of, we certainly want to be transparent, but we also need to be able to confer with counsel in confidence and receive attorney-client protected information. And so you're starting to move into that territory, and I want to be mindful of that. And I think the fact that we have this discussion is good to the extent that we can, and the fact that Doris has created this chart, I think, is good. In fact, I'll be very candid to say that in future meetings, I think we even need to be more transparent in our agenda. It can be part of the administrator's report, but I think the way we've identified it isn't even perhaps robust enough. Maybe it could specifically refer to the project so folks know that that's what we'll be talking about. But I do want to, I think we can say, and we have, and our error corrections policy says it, and we said it in the meeting that we adopted those resolutions, that based on council's advice, we're going back 3 years longer if it was an error that we knew about. And I think that's really the level of detail that's appropriately discussed.
Okay, thank you. And I just think that's good that that's out there.
Two quick comments. One, would the board like to see this as a separate agenda item and not part of the administrative report as far as this report on the project status each month? And secondly, just to mention something in regard to your comment, Sherry, I can say that I've worked for 4 systems, and use of that statute of limitations 3-year look back period has been consistent through all of the systems that I worked for across 2 states.
As far as the comment Doris just made, it really doesn't matter to me whether it's a separate item or not, as long as it's specifically listed, even if it's listed under the administrator's report, if it specifically refers to the project, I think we're fine. I suppose one could argue that it's even more transparent if it's a standalone item, but as long as it's specifically on the agenda, I think we're pretty good.
I'd like to see it as its own agenda item.
Mr. Chair, if I can.
Go ahead.
I think it's another topic to bring up too, just so people that might be listening or concerned about this correction plan understand that we've proposed this to the IRS, and at this point in time, I don't believe the IRS has responded to our VCP that's been filed with them. So while we have made motions and approved those motions to the way we as a board think these matters should be dealt with, at the end of the day, we could get guidance back from the IRS that's not acceptable, and we will have to revisit some of these topics. So I think it's important for the people that are impacted by this and the members of the board to remember, and members of the public and our retirement system to understand that this is our proposal and this is what we voted on. And at the end of the day, it is forward to the IRS for approval.
That's correct.
Okay. All right. Well, we'll make sure that this is a standalone item going forward. Are there any board member reports or comments? Well, hearing none, seeing none, I wish everyone
I have a comment.
happy holiday.
I have one comment.
Oh, go ahead, Lee.
I would highly recommend this book. It's COVID. And as us as major investors, and just what's going on in the world, it's written by the professor of marketing at NYU. And it's an exceptional read. I'm about halfway through it. It's extremely interesting, and it's about what's going on in our world right now and how our world is going to change and is changing. It's really a good book.
Thank you, Lee.
What's the details again, Lee? I didn't see it when you held it up.
That's called Post Corona by Scott Galloway. It's not a political book.
Good.
Okay. Well, I wish everyone happy holidays, and hoping that 2021 is more pleasant than 2020 was.
Oh boy. Yeah.
Happy holidays. Everybody take care.
Good to see you all.
Everyone.
Bye, everybody. Merry Christmas.
Bye-bye.